Hey everyone, it's Martin Shkreli, and this is This Week in Investing, episode 9. It's June 18th, 2017. Thanks for joining me. Let's see. Last week was not that exciting. The healthcare is outperforming tech. These are the two industries I follow. So I think, to me, it means there's a flight to safety, and Bitcoin dropping is also going to be a really good barometer for the next, I don't know, probably 5 to 10 years or longer as to what safety means. And you can sort of tell when the market's becoming more risk averse. The last time I kind of felt like this was 2007, where there are just things that start to happen that kind of make you wonder. And 1 week doesn't mean anything, obviously. It doesn't predict the future. I'm going to get to that in a second, but I think there were some. There's been some flight to safety. I'm going to talk about the yield curve starting to flatten, which is a bigger, more permanent sort of sign that there's a flight to safety. But when pharma stocks and biotech stocks start going up and they've been beaten up, and tech stocks start going down, it certainly feels to me like the big risk on trade is over. We'll talk about the yield curve. I think there's this crude oil depression that is more than a sort of seasonal or whatever temporary thing. I think there's temporary demand dynamics. I think there's a general perception that demand for crude is going to drop and peak even in 20 or 30 years. That even 100 years from now we may never need to drill again. And I think that's keeping crude low. And I'm not so sure that, again, I don't know what the truth is, not being an energy expert, but there's something about that that's kind of interesting. I read an interesting article that Total, the French oil company, is trying to diversify as much as they can into cleaner energy, not because they're worried about their carbon footprint, but because they're worried that oil demand's going to drop over time. And I think that was pretty interesting. Inflation is really tepid, and I want to talk about that as well. But real quick, one of the things that I watch, and you guys know I don't follow macro situation too closely, but I've noticed that I made this graph in Excel. I took the 10-year minus the 2-year, and you can see that you have this pretty big flattening, and no one's talking about it, and that's not good. You don't want this. This is bad. This is what happens before a recession. And when we get closer and closer to 50 basis points or 30 basis points, people are going to say that's an inverted yield curve, or close to an inverted yield curve. By the time the yield curve's inverted, the market's going to be down a lot. And I don't know, this looks like a pretty good trend line to me, about as straight as it gets. And we're at full employment, and PE multiples are pretty high. There's a lot of reasons to wonder about the market. So I just recommend, let's stay hedged if you can. I like I think I see this on Tumblr, just something things, just macro things is my comment here. I did a pretty deep dive into inflation very early this morning, and I think it's really interesting what's going on. I pull up the spreadsheet I showed you, but I'd be wasting your time. There's a lot of interesting things going on with inflation. If you net out some of the more volatile or kind of one-timey, if you will, parts of inflation and the CPI, inflation's really low. And I've been saying that for a while. I think that there's something to that again has bonds have been rallying, the smart money's in bonds. It always has been over the last 10, 15 years. Equities have kind of been no man's land. I think that's probably still the way to go. I think deflation comes to a theater near you in the next year or two, and that's part of the reason yields are where they are. But I think that inflation ticked down quite a bit, which led to a big bond rally and other sort of skepticism that the Fed's going to not continue to raise rates. They have no reason to if inflation's so low. I think it goes lower. So anyway, lots of weird things happening on in the macro world, and again, it makes sense to stay hedged. If you have 100% of your portfolio in stocks, I would not do that. I would try to keep half of your portfolio in cash. Preferably even half of your portfolio should be short stocks that you don't like. If you can't make money shorting stocks that you don't like and buying stocks that you do like, you shouldn't be trading stocks at all, or quote-unquote investing at all. You're just betting on the stock market going up, which is a pretty tough prescription if you ask me, especially after it's gone up so long and you have the yield curve flattening or even inverting. So anyway, let's move on. A lot of people ask me about trading. I'm not a great trader. I've become better over time after making lots of mistakes. But I think that I can give you some insights into how I think about trading. So when I think about trading, I kind of try to balance two things, which is my internal rate of return or annualized rate of return, which is just what it sounds like. And the idea there is that you're treating your capital deployed, your actual capital at work, as your assets under management or what you're focused on, as opposed to your total capital base, which is kind of what the more practical thing to look at is, right? But a lot of venture capital and private equity funds think more about IRR than they think about so-called cash on cash. And there are two ways to look at the same thing, but if you have cash, obviously that money isn't at risk. So basically the dumbed down way to think about it is, let's say for the entire year you were half invested in stocks and the other half in cash. If you made 10% of the year, your IRR is actually closer to maybe 20%, because if you're fully invested with all of your cash, that would be your sort of unleveraged return, if that makes sense. So, or your annualized return or IRR. So you have to sort of think about, if you're not deploying cash, you're really not risking that part of your portfolio, if that makes sense. So anyway, and when I say I try to balance IRR with probability, I'm really talking about probability of the trade continuing to go in one's favor, and we'll talk about that in a little bit. Probably one of the best insights I ever had in my life was the idea that if you could catch 5% in a month in a stock, that's as good as 80% in a year. And it seems to me like it's a lot easier to predict a stock will go up or down 5% in a month than the stock will go up 80% in a year. That makes a lot of sense, right? And in fact, it's probably easier than even a 50% move in a stock. So if a stock is up 5%, let's say, because you think the market's misinterpreting some news, you might even be able to get 5% in a week in a stock if you're smart about when you make that trade. And that's why people like to do trades like that. But you also have to think about the fact that you still need to make great cash returns. So even if you make, let's say, 1% in a day, and you get to do that 5 times a year, you're probably not going to make enough money that it'll really matter on a cash basis. On an absolute basis, you're making like, a zillion % IRR because you're only risking your money for a day. But, that's not a practically sort of relevant thing. So you're asking if 5% a month should be 60% annualized, because 5 times 12 is 60, but that's actually not the case, because if you did 1.05 to the 12th power minus 1, you have 79.6%, which is 80%. So you're not compounding the 5%. So you make 5% a month, but you're making 5% every month. So 1.05 times 1.5 is a little bit more than 10%. It's actually 10.025. And then another 1.05%, you're actually at 1.16. So you start to compound, and obviously the effect gets bigger and bigger each month. So after 5 months, you're at almost 28%. So that's sort of how that works. Anyway, so here's a practical example. The portfolio bought Omeros, and it's up 54% in 17 days. This is a pretty incredible outcome. And sometimes this happens, it's luck in some ways, right? And I have a software I wrote that calculates it automatically. It's a 1,000,000% annualized return. Obviously, no one can make that kind of pace consistently. It's almost impossible. But it does tell you about the power of compounding, and it tells you about how important speed is in investing, and it sort of tells you why quantitative investing works really well. You might ask yourself why quantitative investing is so impressive and why it's so relevant, and it is about taking small moves and making sure that they happen in a short period of time. And if that's 1,000,000% annualized return, obviously, a 10 or 20 basis points a day, say 20 basis points a day, there's 250 trading days a year, that's a 65% annualized return. And 20 basis points doesn't sound like a lot, it's a fifth of 1%. But if you have a program that can make 20 basis points a day, you'd have one of the greatest hedge funds, probably the greatest hedge fund of all time, which is really kind of interesting if you think about it. So what do you do with something like Amros? Do you sell as fast as you can and lock in this crazy gain that you've had? And so I try not to look at the past IRR, because the past sort of happened, and I can quote unquote lock in this gain, but I wouldn't believe in the term lock in. I think that's something that could trick you into making a bad move. The question is, what's the future IRR? The stock's at $24. I think it might be going to 50, and I think most of my arbitrages, or stock picks, if you will, typically take about a year before they converge on my target price. So the question is, that's 100% IRR, right? About a double in a year is about 100% annualized. Sometimes they take longer, though. They can take 2 years, and sometimes I'm just wrong, and I have to think about the probability of that. So basically, I have to start to calculate and adjust, what's the probability I'm wrong? Where does the stock go? Could it go to $1? And I got to factor in, is that a 60-40? In the long run, my hit rate is usually about 63 or 65%. So I have to sort of think about, what's the probability that I'm right? What's the probability that I'm wrong? What's my IRR if I'm right? What's my IRR if I'm wrong? I'll have to think about that. And once it becomes unfavorable, I should exit the trade. I shouldn't exit the trade just because I made a lot of money. I think that's a little bit silly. But let me take you to my next example, which sort of connects. I don't have too many rules in investing, but this is one rule that I think served me really, really well. If you capture 50 to 70% of your intended move quickly, so in other words, I thought that Amros would go from 10 to 50, and it's gone from 10 to 24, which is great, or 15 to 24. But if I think it's going to go from 15 to 50, I've only captured, 20 or 30% of the move. So I'm not quite ready to take profits. But if it got to, say, $40 or $35, I think I'd be ready, because I have mostly gotten what I was looking for. And you should never be upset about taking your profits a little early if you've gotten most of your move. Some people say there's a big adage on Wall Street where people say, no one's gone broke taking a profit. And I don't think that's true. I think you can go broke taking profits. I could probably prove it to you. If you constantly sell all of your stocks as soon as the profits start, all you'll be left with is your losing positions, which you'll never sell, and you'll hold on to, and eventually you'll go broke. So that old saying, nobody's gone broke taking a profit, is ridiculous. But I do think if you're greedy and you need 100% of your target price, say if you buy Amros at 15 and you think it's going to go to 50 and you wait for 50 instead of selling it at 47 or 48, I think that's a little crazy, and you should try to just get out when you can. There's a reasonable chance you'll be wrong. There's a good chance you'll be wrong about the exact move, the timing. Nobody can be that accurate. And the faster the stock goes up, the more room you should have. Like if Amros went from 15 to, say, 30, let's see, it could hit 30, who knows, in the next few days. I'd probably just get out. I've gotten half of what I was looking for very fast. But if it's taken less time, I can wait a little bit longer. So it's all about the IRR, and you have to make some of your own points on this, but I think there's something to think about. This is another sort of trading insight. Adam Feuerstein is a very smart journalist, and a very good journalist. He has a great nose for things, but he's not a professional investor, and he knows that. So I'm not, talking smack out of school, but he said Amros is up 55% for the week, and he says it's up on a breakthrough therapy designation. Then his conclusion is that the market still loves that FDA trophy. That's not why the stock is up. If Amoros said that they, donated $500,000 to the IgA Nephropathy Foundation or NephCure, the stock wouldn't be up because of that. Stocks don't go up and down based on irrelevant news just because it happens at the same time. That's not post hoc ergo propter hoc is kind of the sort of way that people think when it comes to investing. People want to assign causality to events like news, and the stock is up because people like me are buying it because we're smart. It's really cheap stock. It's going to triple, and that's what's happening in Amoros. It just happens in a feeding frenzy. I told a lot of people that I was buying the stock, and I'm not surprised that it's up 55%. It's a really cheap stock. It could go up 10x. Who knows? The point is that people are sort of discovering the stock in a feeding frenzy. Breakthrough therapy is not the reason the stock is up. And again, don't sort of assign the causality when it doesn't exist. I know it's sort of tempting. In the future, you're going to see me watching and trading healthcare debt, which will, I think, help people learn a little bit about the debt markets, especially the high yield markets, which are very equity-like. Concordia has 7% debt trading at 22 cents. This means market is saying the equity is worthless. So if the debt is trading at 22 cents, then the stock is worthless. And if you don't understand that, maybe you take a break from the markets and try to learn a little bit. But I might be interested in buying some of that debt. If the recovery is better than 22 cents, it could be, say, 50 cents or 75 cents, which is very handsome equity-like returns. And don't forget, the company has to pay you coupon on the debt in the meantime. So they only have to be not go bankrupt for 3 years for you to get your money back. And every year after that is so-called free money. Horizon is a stock I like and I'm long, and Horizon is a stock where their debt, which I think has no chance of a default, literally zero chance of a default, is trading at 8%, which is a pretty good place to be. You're senior in the capital structure to the equity, so as in any debt. So it'd be kind of cool to have that paper and yield a safe 8%, a safer 8%. Obviously, high yield debt is still risky, but it's not as risky as most equity. Anyway, obviously I like to look at stocks throughout the day and throughout the week and month. And Loxo is still up the highest for the month. And again, we were looking at that really closely. GTX is now up 50% for the month. I had a friend have me look at this. He actually paid me Bitcoin to look at this. I have to give him his Bitcoin back because he's a very young investor and he shouldn't have paid me that Bitcoin, so I'll return it. But either way, GTXI went up 50%. And I was looking at it. Some of you who watch the live stream regularly probably caught me looking at it, and I'll talk about GTXI in a second. But I'm glad it was on my radar screen because it went up 50%. Obviously, I'd be happier if I bought it. But if what's cool about this, and I really, this is one of the times I'll feel almost feel blessed that the top 3 stocks for this month, I had my nose on each of them. I only own one of them, but at least a few of you know how closely I was looking at Loxo, and some of you saw me looking at GTX. So pretty awesome that I had, of the 3 biggest longs, I owned one, and 2 of them I was really, really close to. PTC I also have, so if you have, you really can't complain about life when the top of the top 1, 2, 3, 4, 5, 6 stocks in your sector, you own 2 of them for the month, and the other two of the other ones you were looking at really closely. I must confess, Dynavax came out of nowhere, and Bluebird I also wasn't looking at too closely, but I still feel great about that. Anyway, enough back patting myself here, but I haven't looked at Eaglet in a while. Acorda we've talked about, Kite we've talked about. Neurotrope is a 0. I would short this stock. I think it's a great short. I can't believe it's up. It'll go to 0. Trust me on that. I don't follow Cadman. I should follow Lexicon. It's kind of interesting. I should follow Sage. Novavax is a dead cat. Pernix, I think, is a dead cat, but I should probably check that out. Radius, I really owe myself to look at that one. Fold, I'm not sure what's going on there. I don't know Acceleron too well. Alexion, of course, we know why it's up. It's because your boy is long it. Joking, of course, we'll get to it in a second. Alnylam's up. We've talked about that, I think. I'm supposed to be looking at Rare, but haven't had the time, and it's up 16% this month. A little frustrating. My old company that was stolen from me, Retrophin, is up 14%. Sangamo, which I'm long, is up 10%. Teva, which I've been meaning to look at, is up 11%, and that's a large cap. So Teva may be bottoming out here and could be returning to success. Not much has changed on the down list. Ulink and Ampio, iGate, Coherus had some bad news. We'll talk about that. Insys is all over the place. Actinium. I did notice that if you look at some of the debt-laden companies like Endo and what's that crazy Canadian company we just talked about it? Concordia. Endo and Concordia both dropped substantially. So the leveraged companies seem to be dropping. I think Mallinckrodt also had a tough week. So it's kind of interesting to sort of see those stocks drop. Insight is down. Medicines Company is down. Those are two stocks that I'm short. I'm very happy to see those stocks fall. I saw Shire Roche dropped quite a bit, which is a little surprising. Nectar dropped. I can't make heads or tails on Nectar. I tried to look at it for a little while, and I couldn't understand it. Current opinions. I added Macrogenics, which I'll talk about in a second. Alkermes looks like a short. We'll talk about 460, which is Siwan. And I don't know if I made too many more changes here. I still have my secret short coming at some point, but I'm working away here. All right, the portfolio had the best week I think it's ever had. So we're now up 4% for the year. I post all my trades, as you guys know, on a weekly basis. So only 50% invested. And on average, I think it was maybe 20 or 30% invested. So annualized or IRR, we're actually beating the market. On an absolute basis, I'd say we're catching up. With no net exposure, you can see that some of the low beta, I should say, Gilead, Bristol Myers, and GSK are like owning cash, if you ask me. So beta here is close to 0. And true gross exposure is also lower than it looks. So we're doing really, really well. I'm really lucky about that. I hope some of you guys have made some money on this. Twitter is not my secret short because it's my real short here at 80 basis points. So I added Siwan, if you want to look at that. It's a Chinese drug company, and they really are a bona fide drug company, unlike Sinopharm or some of the other Hong Kong stocks. I think that your portfolio should be at least 20% international, and I have a bit to catch up on this. But I do think that if all of your stock picks are in the U.S., you're probably not doing a great job. There's a lot of international stocks out there. Most of them are less traffic than the U.S. ones. There's tons of arbitrage out there in those markets that's better than the American markets. So if all of your stock picks are American, you're kind of a piece of trash, and I encourage you to look into some foreign stocks before you hurt yourself. It's a little too forceful, of course, I'm kidding. I added Macrogenics, which is a really interesting antibody company. They seem to have an endless amount of interesting antibodies, so I just decided to buy some. It's a really cool, kind of a cool company. So those are my only 2 additions to the portfolio. Alexion had a monster week. I actually trimmed some, so I sold a little bit of Alexion. I bought a really big position that was a little bit outside my comfort zone because of the dramatic move that it had. It was up quite a lot, and I got to sell some at a really good price. So I was happy to ditch a little bit of that extra Alexion that I was carrying around, and now it's maybe a more normal size position at this point. But it was at one point a really insane kind of investment at 7 or 8% of the portfolio. Gilead, Regeneron are still kind of old standbys. Gilead is a very low momentum stock, so I kind of like reversion to mean, this investment philosophy that A lot of quant funds follow that. Stocks that are temporarily out of favor may return into favor, and stocks that are temporarily in favor may fall back out of favor. And you don't want too much reversion to mean in your portfolio because it becomes a factor. And if you have factor exposed, you can be in trouble if that factor goes out of favor in general. So in many ways, you could have a stock like, say, Snapchat right now is out of favor. So if you only are buying out of favor stocks and shorting in favor stocks, you're not really hedged. You're really just trading the factor as opposed to trading individual stocks. So you want to make sure you're balanced across factors because otherwise you could just trade the factor. Now you can't, there's no ETF for in favor stocks or out of favor stocks, but you basically make your own ETF when you have a portfolio. So I had an out of favor stock and an out of favor stock in Alexion. We could even highlight these, say red for out of favor. So Alexion and Gilead are out of favor. Avexis is out of favor. Regeneron is very much in favor. It's a hot stock. So you want to see, a lot of times I think on some TV shows they say, am I diversified? Well, you have to be diversified across factors, not just across industries or say anything like that. I think Bristol-Myers is pretty much neutral, as is GSK. Omeros is very in favor. So you can see I'm kind of diversified with respect to this factor. Spark is in favor. Sangamo is very in favor. Unicure is out of favor. So you can see, there's some pretty good diversity in the factors. Obviously, the bigger positions, you can add them up yourself and kind of see if you're factor exposed. And I suggest you do this with your investments. Acadia is out of favor now, which is how I like my shorts to be. Insight was in favor for a long time, so I'm just going to still mark it green. Neurokin is really in favor. Medicines Company is in favor. Neurotrope is out of favor. So you can see I kind of am pretty mixed across factors, and I think it's a really interesting and important thing to make sure that you are hedged across factors. And factors, so if I undid all of that, you could also do it by large cap, small cap. You could do it by sector. You can do it by all those things. And you want to make sure that you're factor neutral, if you can be. Otherwise, at least know that you're exposed to a factor. And things that are supposed to revert to mean won't revert to mean if the market goes down. They won't revert to mean if there's flight to safety, depending on that. So you just have to really think about all of that stuff. All right, so some healthcare news. GTXI, like I said, had those SARM results for SUI. SARM is selective androgen receptor modulator. The androgen receptor controls things like testosterone binding. It's the canonical testosterone receptor. Testosterone's the ligand for the androgen receptor, so that's why we call steroids androgens. In any event, they had some SUI. So SUI is stress urinary incontinence. It's a disease that predominantly affects women. They had some really good results, although it was uncontrolled, so I tend not to trust uncontrolled results. So in any event, I think that SARMs are really interesting molecules, but SUI is not the best place to kind of put a SARM. I think that DMD is the best place to put a SARM. So maybe I'll buy a SARM. You can buy a SARM from a big pharma for probably less than $1 million, and then take your SARM company public for hundreds of millions of dollars. So anyone who does that, good luck to you. But I just gave you the recipe for a big success. Coherus had a CRL for their biosimilars, that stock dropped. I mentioned debt-laden stocks are dropping. Avexis finally had their big news, and it was a kind of a snooze fest. It was sort of as people expected. I think some people were saying it was worse than expected. Some people, like me, thought it was pretty good. The company's going to have to do their phase 3 for spinal muscular atrophy. I think they can do that pretty quickly, given how amazing their phase 1 results were. You could see this drug FDA approved pretty quickly, given how fast the clinical trial will take and how quickly the FDA will review a drug for dying babies, which I think is a priority. Obviously, when I joked about buying the SARM, yes, $1 million is a lot of money, but you might be able to get a SARM for less. But I think most big pharmas don't generally, pimp out their drugs, so to speak, for less than $1 million. But we'll see. Alexion and Biogen swapped CFOs, although Alexion didn't send their CFO to Biogen. Biogen sent their CFO to Alexion, so Alexion stock jumped probably too much, so I sold a little bit, and it came back down on Friday, so maybe if it comes back down some more, I'll buy back what I sold. I still think Alexion's going to 150 or more, maybe 200, but it moved up so fast that I decided to take a little haircut, and that was, I think, pretty good. But anyone else who's holding Alexion, I would not worry, and I do think that the stock's back on track, and people will forget about the Bloomberg article, which was fake news, that was Trump-worthy fake news, and they'll have a good Q2, which is really important. Once they have a good Q2, people realize that it was really, really fake news, and that Alexion will be back at 130 or 140, I think. Idorsia went public. This is the Actelion spin-out, and the J&J Actelion deal closed. So, it's like they say, with one door closing, another door opens. So J&J has finally bought Actelion for $40 billion, and Jean-Paul Clozel will attempt to make Idorsia the next Actelion. We'll see. Xeljanz had a head-to-head study against Humira, and it actually had a numerical superiority, not statistical superiority. But the reason I'm mentioning this is not because Xeljanz is super interesting or that you should buy Pfizer stock, which you shouldn't. It's that a lot of beginners, when they look at drugs, they think that, oh my god, so Xeljanz is 44% response rate, and Humira is 42% response rate, and Humira is an $18 billion drug, Humira. So you would think, if Xeljanz is better than Humira, it has to become an $18 billion drug too. No, that is not the way drugs work. And this is something that a lot of beginners don't understand. Doctors get comfortable with medicines, and they like to use medicines, and they don't stop using medicines, even if a better medicine comes around. And Xeljanz isn't better than Humira. It's not statistically significantly better. It's numerically maybe a hair better. But it's not the kind of thing that's going to make people jump to Xeljanz. Even though Xeljanz is a pill and Humira is an injection. Xeljanz is selling about $1 billion, I want to say, and Humira is selling $18 billion. And Xeljanz is not a new kid on the block. It's been here for now 3 or 4 years. So it just goes to show you that new entrants don't really, in pharmaceuticals, they don't really change the market that much. And it's something to really think about. Now, I'm only talking about branded entrants. But anyway, moving on, Sandoz files their generic Advair. So it's kind of interesting to see, Novartis is a gigantic drug company, right? Sandoz's Advair is not going to move the needle for Novartis. But the fact that generic companies are starting to tell the world that they're making ANDA filings is kind of interesting. Another really interesting drug is Celgene's CC220. They had some positive data for lupus. That's not that exciting. What's exciting about this is the mechanism of action, which is cereblon. A long time ago, Celgene revealed, about 3 or 4 years ago, maybe 5 years ago, Celgene revealed how thalidomide works. Nobody knew how thalidomide worked other than it caused birth defects in the 60s, and in the 80s and 90s it was found to be an amazing anti-myeloma drug, anti-cancer drug. And now they finally discovered that cereblon is actually the receptor or the kinase that thalidomide inhibits. Now, Celgene created a direct cereblon inhibitor called CC220 that is not structurally related to IMiDs, I don't think. I actually think you can make $1 billion or more designing cereblon inhibitors, but again, that's for you guys to maybe do. Maybe I'll do it too, who knows. I noticed that NGF antibodies got fast track status, which was really cool. People have sort of forgotten about NGF antibodies like they've forgotten about Dre. I should have put a Dr. Dre GIF here. But NGF antibodies could actually become the next big antibody class. Obviously, you have the migraine CGRP antibodies coming, but people are sleeping on the NGF antibodies probably because no small company owns one. Most of the big companies that are the ones that own the ones that own NGF antibodies are companies like Pfizer, Eli Lilly. I think J&J has one, and you can probably, I think Pfizer even had 2 at one point. You could probably buy an NGF antibody on the cheap as well. I think there are a few lurking around, and that would also be a really good asset to put into a public company. So in any event, NGF antibodies, people are sleeping on them, and I wouldn't sleep on your boy. Gilead filed for bictegravir, which is kind of interesting. And then Biomarin, Sangamo, Unicure, and Spark are all going to present at the Hemophilia Conference, which I think will be really interesting. I'm not sure why I did the thinking face. One of these things got me thinking pretty deeply, but I can't remember which one it was. So I'll leave that to you. All right, that's enough for healthcare. Let's go to tech for a minute. Amazon's been in the news, and I'm not going to talk to you about Whole Foods too much. I will in a second, but I do want to point you to the original Amazon front page, which is pretty incredible. If you look at it, this is a company that Jeff Bezos said he had a 30% chance of succeeding, which again, if you think about it, is really remarkable. And this is what the homepage looked like. So anytime you start a company and you kind of think, oh man, this is a crummy company, I'm sitting around in this crummy office, my crummy assets or stink, whether it's a website or a drug or whatever, just remember that you got to keep a positive outlook. You can't ask, just like a stock, you can't dwell on where it's been. You got to dwell on where it's going. And obviously, Amazon's front page, I'm not even sure it still looks that great, to be honest. So I think in 10 or 20 years, we're going to laugh at that too. And just for fun, this is Salesforce's one of their first websites, and it's not so pretty either. Online Salesforce automation that makes software obsolete. Obviously, software. What is software? It's starting to. People are starting to wonder what software is. Here, even Salesforce is saying that their online Salesforce automation makes software obsolete, and they're talking about, of course, installed client-server type software. Well, what's funny is that they're not sort of thinking about their company as a software company, which is obviously as a software company, but their phone number is 1-800-NO-SOFTWARE. This is a time in the client-server architecture where software makers like Siebel and PeopleSoft, where the CRM, Siebel especially, Oracle and SAP also CRM software. PeopleSoft was the Siebel version of Workday, and the end of software, 1-800-NO-SOFTWARE. The whole point is no software to buy, install, or upgrade. But nowadays we think of it, this is software. Of course this is software. This is just software on a different OS. It's the web OS. So it's just sort of a funny thing. It's funny because there still are companies that need this kind of attitude applied to them. So we'll see how that goes. But I think it's important to sort of think about the history of these companies, and might help you a little bit for kind of where things are going. Couple things on the tech news. Amazon Whole Foods. There's nothing too surprising about this. Amazon's been teasing a lot about groceries. One of the things that's really interesting to me is that two little factoids you probably didn't know is 90% of retail goods are still sold in person, in an in-person, non-internet fashion. So a lot of people say, oh, what's Amazon going to take over next? They actually haven't taken over anything. So, Amazon still has a long way to go, which may surprise you. And that's something that's not too well known. The other thing that really surprised me is half of Walmart sales are groceries. That seemed crazy to me, but it's true, and that's something that it's a $200 billion company. So $100 billion of their market cap is groceries, and Amazon just bought Whole Foods for $13 billion. Think about that; could be a pretty good deal. Anyway, Microsoft has actually done a lot of stuff in the last week or even few weeks. So they launched a laptop, which got kind of mixed reviews, but it looks pretty good. They have a new version of Microsoft Pix, which seemed like a really space-age kind of photo software, if you can believe that there's space-aged photo software. There's a Microsoft Surface Phone, which has been in the works for a while, but some more details are starting to emerge that this is supposed to be the iPhone killer. We'll see about that, but it is something to think about. Microsoft NAC is the newest addition to Microsoft's GitHub. It's actually a command line sort of toolkit. It's a CLI SDK for Python, but I think it was kind of interesting that it's always interesting to watch Microsoft's GitHub. This will never be important, but it's still kind of interesting, that Microsoft, which invented, in some ways, I wouldn't say they invented the CLI because that's not true, but they maybe popularized the number one CLI of all time, DOS, at least on a microcomputer. Unix was there before DOS, but DOS was programmed by some of the original Microsoft people, and again, it's the first CLI. It's kind of funny to see Microsoft still playing with CLIs. Nothing innovative there, but really kind of funny. And then there's Microsoft Academic. So go to academic.microsoft.com, and there's some interesting stuff. Microsoft never ceases to amaze me that they don't give up, and I think there's a lot of things here that they're working on that are somewhat interesting. And again, I wouldn't sleep on Microsoft for potentially eventually figuring out the phone business, or the small PC business, however you want to call it. They're certainly trying with Surface and the laptop. So everyone wants to do hardware. The software companies all want to be hardware companies. The hardware companies all want to be software companies. It's really interesting to see how that'll play out. I think there could be a little bit of a bubble there. So it's the last 2 weeks of Q2, so make sure you get your insider information. Do your channel checks. It's an old tech joke. I would say that it's an inside joke, but that's not funny. But certainly in the last 2 weeks of the quarter, people tend to try to figure out what's going on with the Q2. Companies are even right now starting to schedule their Q2 earnings calls, so we're going to be back into earnings craziness just in a few weeks, so can't wait for that. Apparently there's this little reveal in the GAO that the SpaceX's rocket launch is 85% less. It's about $65 million versus Boeing and Lockheed, which cost $400 million to launch a rocket. Which, if you think about what SpaceX is doing with what they're trying to do, what they're going to do with their telecom business, that's a really serious disruptor for Verizon and some of these other companies that I think could be great shorts. The entire telecom industry, basically. If you think about market cap to take over, Walmart's market cap is what Amazon sort of salivates and puts on their lunch food table, or their dinner table, I should say. There's $1 trillion or more in telecom market cap that SpaceX, Facebook, and Google could disrupt. And Google's kind of not, Google's kind of giving up on fiber. They're going to try to do some other things. I'm not sure what Facebook's doing. SpaceX has articulated a real rocket strategy to do satellite internet for the planet. Facebook's talked about it as well, but that's where I see true practical disruption that you could hold EPS, earnings per share, in your hand, is telecom. I'm talking China Mobile, AT&T, Verizon, T-Mobile, every European carrier, Deutsche Telekom, British Telecom, etc. All of those companies could be disintermediated by SpaceX. Internet. Is there a content bubble? I have to ask, because Apple is hiring these Sony video, Sony Music executives who did TV stuff, and not Sony Music, Sony TV and Sony Video, including some Breaking Bad people. What's weird is that everyone wants to do this, right? Apple's doing this, Tencent's doing this kind of stuff, Microsoft is probably going to be next, Amazon's been doing it, Netflix, of course. Google might jump into the content game. What the heck is going on? I think it's really strange, and what's interesting is the number of scripted TV shows has actually doubled in the last 5 years. The amount of time I have to watch TV has not doubled in the last 5 years, nor has anyone else's. So I wonder if it's who wins in this. It seems to me like it's really hard to win, because actors don't want to get paid less. The ability to shoot a show for less, I don't think exists. I think that high quality show costs whatever a high quality show costs. So there's a pretty big content bubble, I'd say, and I wonder who you short as a result. I wonder if you short, say, video games, especially the traditional companies like Electronic Arts. I'm not sure people need the 95th Need for Speed or the 95th Madden or 34th Madden and the et cetera, et cetera. I'm not sure if Tencent's a short. Again, I wonder, we have so much, content's getting cheaper and cheaper and cheaper, and it's clear users don't want to pay for it as their choices expand. So I don't know. We only have so much entertainment time and only so many entertainment dollars, and it's a pretty easy supply and demand concept, which I think is interesting. As usual, Slack is pursuing the sale for the fifth time, I think, and Amazon is rumored to be the acquirer. We'll see what happens there. I am not a big fan of buying Slack for $9 billion. I would not do that if I were Amazon or Facebook or Google, but who knows? For the fifth time, maybe they'll actually get a sale done, but we'll see. All right, some Q&A. There is a book being written about me. You can go find and learn more about that somewhere online. Aaron wants a copy of the book. You will not get a copy of the book or any of its content, principally because I'm not sure I have any of it. There are some pretty cute baby pictures that my family's unearthed. I find them to be cute. You will not, most likely. But as they say, a face only a mother could love is mine. But you cannot get any content from the book. No, sorry, Aaron. No one would buy the book if I did that. And plus, I don't have a lot of that content. Richard asks, and again, I'm not trying to make fun of you, Richard, because you asked a good. He's actually the guy who gave me GTXI, but he said, "What are the red flags for a penny stock?" I would say the biggest red flag for a penny stock is the fact that it's a penny stock. I'm being a little tongue-in-cheek here, but generally, I would avoid any stock with a market cap below 100 million, unless you're really a professional and you know what you're doing. Market cap matters more than stock price, but if it's a low stock price and it's got a low market cap, try to avoid it, I'd say. You could probably get hurt if you do that. And it actually dovetails with another question that I got a little bit later from JK here. But before I answer that question, I'll say, when you say stocks don't go up in the long run, what do you mean? A question from my good friend JK. And my response to that is when I say stocks don't go up in the long run, I mean stocks don't go up in the long run. That's really it. That the average stock does not rise over time. And I really have a lot to say about that, because the same person asked me, if Trashy picked 10 stocks, what would happen? And this is actually, all three of these are kind of the same question. And I don't think the average person would realize that. But the answer that connects them all is that the median stock drops. The most likely return that you'll get in a stock is down 100%. It's the most common return. Median stock and mean stock price are different because the indexes are market cap weighted, so they're a bit self-fulfilling, and they have selection bias and survivorship bias. Whereas the average stock goes bankrupt, or the median, the mode, if you will, the modal stock goes bankrupt. And spend a lot of time thinking about that in distribution-weighted returns or distribution of returns. You'll sort of understand what I mean. That it's in fact the stock market. I think over the last 5 years, most of the return in index has come from the top 5 stocks or something like that. And the point is that all those other stocks are inconsequential relative to, say, an Amazon or an Apple or whatever. And the idea is that the average stock the average stock's poor performance kind of gets drowned out by those mega stocks when you look at an index. So you have to be really careful when you're picking stocks, and that's why shorting the average stock is actually maybe not such a bad idea mathematically. And again, I'm giving away too many of my secrets here, but I think that you'll if you dig deep enough, there's some riches to learn here about the fundamental governing dynamics and underpinnings of equity markets that you have to search deeply to find. Aeto asks me, how do I deal with loneliness? I would get a dog. Just dogs will help you with that. They're very friendly. They will sit by your feet and make sure you're never lonely. That's my advice. If you need more, ask me a more direct question. A lot of good questions here. I'm going to try to get through all of them. I didn't write the answers ahead of time because I thought some of them would be interesting to answer on the fly. What is the max bet someone should make on a stock, Chris asks. There's actually no good answer to this. A lot of people have hard and fast rules like 5% or 10% or whatever it is. And I don't think there's a hard and fast rule here. Obviously, I've certainly learned over the years, you should have some limit. But it reminds me, George Soros, the famous Soros trade with respect to the pound, which has been written about many, many, many times. You should think about the potential for loss before you think about the potential for gain. But at the same time, there's some trades where you can structure them in a way that the potential for loss is very well defined. I like trades like that, more than I like unbounded loss. But sometimes even then you can take some amount of unbounded loss risk. But Warren Buffett has a really good saying when it comes to this. He said, "I will never play Russian roulette with any gun. Even if there is 1,000,000 barrels and one bullet in one barrel, I would not want to play the Russian roulette and bet that the barrel would spin," as my great friend Chameleonaire once said in his rap. You certainly don't want to play Russian roulette if there are 2 chambers, or 9 chambers and 8 bullets. But regardless, some people are willing to make that kind of a bet, some people are not. I think you have to ask yourself, but it's safer if you have a bet that cannot put you out of business. Now, theoretically, any short bet of any size could theoretically put you out of business, but do your calculations carefully and see how many sigmas it would take and things like that. So I hope that gives you some sense for that. Is it okay ethically for Goldman Sachs to buy Venezuelan bonds? Well, oh boy, that's a tricky one. I don't know that they're supporting a communist regime by buying bonds. In fact, they could actually be helping feed Venezuelans by buying bonds. Now, you might say over the short term that's true, and over the long term they may be substantiating this terrible regime. But I don't know, I think the regime is bad one way or the other, and buying those bonds could be a good investment, and it could be helpful to the people of Venezuela to have some cash running through their country, which that the problem has been that they have no currency. Are there iconic companies that every good analyst should know the history of? I'd say yes, and in fact, I would learn from the non-iconic companies too. I would learn the company history of every single company I could. And in fact, that's what some of my hero investors like Warren Buffett do. How does brand value affect stock price? Is it hard to short blue chips, therefore, is his conclusion, Aaron here. I almost put this in the dunce category. I know Aaron means well. There are plenty of blue chip, quote-unquote, stocks that have disappeared. Xerox, Kodak, Sears, Radio Shack. These were all blue chips at one point. Even things like Hewlett-Packard, some blue chip, huh? There's a lot of quote-unquote blue chips that have gone by the wayside. So what's today's blue chip may be tomorrow's, potato chip. How do you deal with loneliness? I answered that question. Maybe I'll answer Get a Cat as well. How do you do you try to keep your models simple? I thought this was a really great question, and I could probably talk about it for an hour, but I only have 8 minutes left. I think if you can't forecast a company's revenue easily, then you probably are not doing it right. I once had a 65-page model of a drug company that was totally inaccurate. And now I make perfect models on 1 page or 2 pages. I don't know. There's obviously companies that are harder to model than others, but the more you know your space and sector, the easier it is for you to model. Warren Buffett says he can do all of his modeling in his head, that there's a handful of numbers, a handful of formulas, and he never forecasts earnings for each quarter. He does long-term kind of forecasts like I do, and it's not that hard to kind of keep it simple and come up with whether a stock is cheap. So yeah, I'd say keep it as simple as you can, but obviously, there are considerations that must be taken, like the next one there here is tax cuts. How do you think about tax rates in general in your models? I actually do think about companies that have 30 or 40% tax rates as potentially having a smaller long-term corporate tax rate, as Trump tends to drain the swamp. This may lower tax rates for companies like United Healthcare, which are U.S. only. United Healthcare could be a good long based on that. Now it's already gone up quite a bit. This question came from Stephen, who also said he bet my cousin Vincent. I do not have my cousin Vinny. I do not have a cousin named Vincent. The person lied to you. They said that I was hanging out with them at a family reunion. My family's never done a family reunion. We never will. So yeah, no cousin named Vinny. Give me advice on my AYS model. I don't have enough time. I have 6 minutes left, but I was going to roast your model. Maybe next time. This segment has taken longer. I can talk slower if I want and make these things last as long as I want. So I'm kind of solving for 1 hour here. Someone also asked me to look at Cara or Amphistar. Let me roast it real quick. Let me roast it real quick. All right, you have to learn how to use the right adjust button. That's my first thing. I don't know what these dates are, bro. 31/12/2016. I don't know what to tell you there. let's see here. You got a discount rate of 9%. That's kind of high for a company that looks like it's pretty stable. So I'd say that's garbage right there. I don't even know what this company freaking does. Let's see. SIM only, broadband, competitors. The stock appears fairly valued, if not slightly undervalued. There's not enough arbitrage. Okay. They have a market cap of $349 million, but cash of $9 or $9,000. Dollars of thousands. I don't think this $350 million company has $9,000 of cash. It just seems like not enough cash. I think Trashy has more than $9,000 of cash, so you might want to look at that one. You know, when you say numbers are dollars and thousands, you probably should mean it. I think you're doing dollars and millions or dollars. I don't know what you're doing, in fact, because even if it were 9 million, that still wouldn't make any sense. So anyway, this model's garbage by definition. But yeah, you know, I don't know. Let's see. Closing subscribers, ARPU. I don't know. This is an Australian company. I don't really mess with Australia in general. I don't know, man. It's definitely a trash model. I will say that. But there's no interest income, and you don't. Yeah, this is bad because the whole point of net income is that you reinvest it. I know people who are not good at managing companies don't agree, but that's the whole point of capitalism: is you make money and then you put your money into a high return project. If you can't do that, you do a buyback. So you don't have this capital actually doing anything. So there's no part of your model where cash is accruing, right? You have cash going up by 1%. This doesn't make any sense. If cash is $22,000 in 2016 and they make $12,000 in 2017, ending cash will be $35 million. So that's pretty pathetic. You also have shares outstanding going up 5% a year. Any company that would have shares outstanding going up 5% a year would go bankrupt. Shares outstanding shouldn't go up after a while, especially if you're profitable. Why are shares outstanding going up? Why are they issuing 5% of their company to some mysterious figure every year? That makes no sense either. So I give your model a D minus. Thanks for playing. Anyone else who wants to play can send me a model. All right, what I'm reading, I'm preparing for my court case, which starts next week. I'm reading the journal J Compute Chem, which you're welcome to read. It is not a page turner, I'll tell you that. And then I got this book, Pro Mern Stack. You've heard of Meme Stack. Now you've got Mern Stack. Mern Stack has React instead of Angular. So now that there's a book called Mern Stack, I think it's the top of React. But you know, we'll sort of see how that goes. So anyway, you can email me, martin@thoughtpatrol.com. Email me about whatever you want. I do have a new Twitter. Don't tell anybody. It's BLM Bro, Black Lives Matter Bro. I think because I chose Black Lives Matter, Twitter can actually not legally ban me. It's hard-coded into their system that they can't ban anything that has Black Lives Matter, so I've cheated the system on Twitter. And you can sign up for Godel Systems at godel.systems. It's a top-secret software I've been working on for, I don't know, maybe a year, maybe more seriously for about 5 or 6 months, 3, 4, 5 months, super seriously. Godel is my software company. It's got about 10 hardworking, brilliant, beautiful people, and we're going to change the world with our software. So sign up at godel.systems. It is confidential. You cannot talk about Godel if you sign up, and if you have a LinkedIn, we'll approve you relatively very Anyway, thank you guys so much. It's been an hour on the dot. Really appreciate you visiting in every week. Very happy to see the portfolio performing well. Hope some of you, I know a lot of you have emailed me saying you're making some good money on it. It's my pleasure. I'll talk to you guys later.